Bitcoin stands resilient at the $64,000 mark, holding firm against a backdrop of heightened volatility and shifting investor sentiment that has left many in the financial community wondering if this is the prelude to a significant upward breakout across the cryptocurrency landscape or if caution remains the order of the day. This pivotal moment comes after a tumultuous period in which the leading digital asset soared to record levels before experiencing a sharp retracement that tested the resolve of even the most seasoned market participants, prompting serious questions about the sustainability of the current structure and the timing of any potential acceleration higher. Welcome to Crypto Hub, your premier destination for comprehensive and professional cryptocurrency market analysis and updates designed to provide clarity in an often complex and rapidly changing environment. Today, we turn our attention to Bitcoin's current consolidation around the psychologically and technically significant $64,000 level, dissecting the factors at play and assessing the probabilities of an impending massive breakout that could signal the continuation of the broader bull market, or perhaps even the start of a new parabolic phase, with implications reaching far beyond short-term price fluctuations into the very foundation of institutional adoption and long-term value accrual for digital assets as a whole. To fully appreciate the current situation, it is essential to contextualize Bitcoin's recent price trajectory. Having achieved an all-time high exceeding $126,000 in October of 2025, Bitcoin entered a corrective phase that saw it decline by approximately 50% at its lowest points earlier this year, touching levels near $60,000 amid a confluence of profit-taking leverage, unwinds, and broader macroeconomic pressures, including fluctuations in traditional equity markets and evolving monetary policy expectations from major central banks. The recovery from those lows has been gradual, with the price action forming what appears to be a basing pattern around the $64,000 zone, where buying interest has consistently emerged to absorb selling volume, suggesting that this level represents a zone of strong demand from both retail and institutional players alike, who view it as an attractive entry or accumulation area rather than a point of distribution. This resilience at $64,000 stands in stark contrast to the more dramatic capitulations seen in prior cycles, where similar percentage drawdowns often led to prolonged bear markets. Instead, the current environment reflects a more mature market structure, supported by deeper liquidity pools and sophisticated participants who are less prone to panic selling. From a technical standpoint, the $64,000 area has proven to be a battleground of considerable importance on the daily chart. It aligns closely with key moving averages and previous support-turned resistance structures from earlier in the cycle, making it a focal point for traders monitoring for either a decisive break higher or a failure that could invite further downside exploration. Indicators such as the Relative Strength Index have hovered in neutral territory, neither overbought nor oversold, in a manner that would suggest immediate exhaustion in either direction, while volume profiles indicate clustering of activity around this price band, underscoring its role as a decision point where supply and demand are finely balanced. A sustained close above $66,000 to $67,000 with accompanying volume expansion could open the door to retesting higher resistances at $70,000 and beyond, potentially accelerating momentum toward reclaiming the previous peak and establishing new records in relatively short order. Conversely, a breakdown below $62,000 might target the $60,000 psychological support where additional accumulation could occur, but also where stop-loss cascades in leveraged positions might exacerbate any downward move, creating short-term volatility that tests the conviction of holders across the spectrum. Moving averages on multiple time frames show the price oscillating around critical thresholds, with the 50-day and 200-day lines providing dynamic support and resistance that further highlight the importance of a clean break in either direction to establish the next trend leg. Delving deeper into the on-chain landscape reveals a more nuanced picture that supports the notion of underlying strength, despite surface-level price stagnation data from various analytics platforms indicates that large holders, often referred to as whales, holding between 1,000 and 10,000 bitcoins, have been net accumulators in recent periods, transferring substantial amounts from exchanges to private wallets in a classic sign of long-term conviction and reduced immediate selling pressure. This behavior echoes patterns observed in prior market cycles, where such accumulation phases preceded significant appreciation, as the reduced liquid supply on exchanges creates conditions ripe for upward pressure when demand returns from either spot buyers or renewed institutional channels. Furthermore, metrics like the market value to realized value ratio have approached levels historically associated with accumulation zones rather than distribution, implying that current prices may represent value for long-term holders who are not capitulating but rather positioning for future growth based on fundamental scarcity and adoption trends. The absence of widespread capitulation, evidenced by stable or even increasing active address counts and transaction volumes in certain segments, further bolsters the case that the market is in a healthy consolidation rather than a terminal decline, with dormant coins remaining unmoved and long-term holder supply continuing to trend upward in a manner consistent with previous pre-breakout periods. Institutional participation through spot Bitcoin exchange-traded funds continues to play a transformative role in shaping market dynamics, even as recent flow data has shown periods of notable outflows totaling several $billion over consecutive weeks in the early part of June. These outflows, while headline-grabbing and contributing to short-term pressure, must be viewed against the backdrop of cumulative net inflows surpassing $50 billion since the product's inception, reflecting deep and growing integration of Bitcoin into traditional investment portfolios managed by major asset managers with billions in assets under management. The outflows appear largely cyclical, tied to profit realization following rallies and temporary risk aversion amid macro uncertainties, rather than a fundamental rejection of the asset class, as evidenced by the fact that even during drawdowns, the overall infrastructure for institutional exposure remains intact and ready to absorb capital when sentiment improves. Should these flows reverse back to consistent positive territory, as they have done multiple times in the past, it could provide the catalyst needed to propel Bitcoin decisively above current resistance levels, attracting additional capital from pension funds, endowments, and other large allocators who have been waiting on the sidelines for clearer technical confirmation. Macroeconomic factors add another layer of complexity to the outlook, with global markets navigating uncertainties around interest rate trajectories, inflation persistence, and geopolitical tensions that occasionally flare up to influence risk appetite. Bitcoin's correlation with traditional risk assets has at times intensified, leading to amplified moves in both directions. However, its evolving narrative as a potential hedge or digital gold alternative, coupled with increasing corporate treasury adoption by forward-thinking companies, and even discussions around sovereign reserves in various jurisdictions, positions it uniquely for potential decoupling or outperformance in certain scenarios. A dovish turn in central bank policies or resolution of trade and geopolitical frictions could easily coincide with renewed crypto enthusiasm, creating a perfect storm for the kind of breakout many are anticipating, particularly if it coincides with positive developments in ETF flows or on-chain accumulation signals. The maturation of Bitcoin as an asset class means it is no longer solely driven by retail speculation, but increasingly by how it fits into broader portfolio construction alongside equities, bonds, and commodities, making macro clarity a key variable in determining the timing and magnitude of any upside resolution from current levels. On the catalyst front, several developments could ignite the next leg. Higher renewed strength in ETF inflows would be paramount, signaling returning institutional confidence and providing the bid-side liquidity necessary to push through overhead resistance with conviction. Corporate announcements of additional Bitcoin acquisitions building on the strategies pioneered by entities like MicroStrategy could serve as powerful signals that even during periods of consolidation, smart money continues to see asymmetric upside in holding the asset over multi-year horizons. Regulatory advancements providing clearer frameworks for digital assets in major economies would reduce uncertainty and encourage broader participation from both traditional finance players and new entrants who have been hesitant due to compliance concerns. Technological progress on the Bitcoin network itself, including enhancements to scalability, security, or Layer 2 solutions that improve usability and transaction efficiency, might attract new users and capital flows that reinforce the fundamental value proposition beyond pure price speculation. Additionally, broader market sentiment shifts, perhaps triggered by favorable economic data or successful navigation of current headwinds could flip the narrative from caution to optimism almost overnight, leading to a rapid repricing higher as short positions cover and sidelined capital deploys in search of momentum. Yet it would be remiss to ignore the risks and counterpoints that suggest the breakout may not be immediate or guaranteed. The recent streak of ETF outflows highlights vulnerability to sentiment shifts, and if macro conditions deteriorate further with stronger than expected economic data leading to delayed rate cuts or persistent inflation concerns, risk assets including Bitcoin could face additional headwinds that prolong the current consolidation or even force a retest of lower supports. High levels of open interest in futures and options markets mean that any sharp move could trigger cascading liquidations, potentially overshooting levels in the short term and creating false signals that trap both bullish and bearish participants before the true direction emerges. Chart patterns, while showing consolidation, could also resolve to the downside if key supports fail, leading to a retest of lower bounds around $55,000 to $60,000, where new accumulation might form, but at the cost of significant drawdowns for those entering at higher prices earlier in the cycle. Moreover, the maturation of this cycle, with institutional dominance differing markedly from the retail-driven euphoria of previous bull markets, means that moves may be more measured and less parabolic than some historical precedents, requiring patience from market participants who are accustomed to quicker resolutions. For the wider cryptocurrency ecosystem, Bitcoin's performance often serves as the tide that lifts or lowers all boats. A confirmed breakout above $64,000 with conviction could pave the way for altcoin rallies as capital rotates into higher risk, higher reward assets. Once Bitcoin establishes its leadership and reduces the perceived opportunity cost of venturing into smaller cap names. Sectors such as decentralized finance, non-fungible tokens, Layer 1 smart contract platforms, and emerging narratives around artificial intelligence integration or real-world asset tokenization stand to benefit disproportionately from renewed overall market momentum as liquidity expands and risk appetite returns across the board. However, until Bitcoin clears its hurdles convincingly, many alternative cryptocurrencies may continue to languish in relative underperformance, or range-bound trading testing the conviction of their holders and highlighting the importance of Bitcoin as the primary benchmark for the health of the entire digital asset space. This dynamic underscores why monitoring Bitcoin's ability to hold and break from $64,000 is not merely an exercise in price watching, but a window into the broader capital allocation decisions that will shape the trajectory of the industry for months and years ahead. In assessing whether the next massive crypto breakout is about to start, the evidence presents a compelling but not conclusive case for optimism tempered by realism. The holding at $64,000 amid adversity demonstrates resilience. Whale accumulation points to smart money positioning, and the institutional infrastructure built over recent years provides a foundation stronger than in any prior cycle, with deeper liquidity and more sophisticated risk management tools available to participants. At the same time, the lack of immediate volume surge or decisive technical breakout combined with ongoing ETF outflows and macro overhangs suggests that the market may require additional time to digest supply-build energy and await clearer catalysts before committing to a sustained directional move higher. It is entirely plausible that we are witnessing the later stages of accumulation within a larger uptrend, where patience is rewarded with substantial upside in the coming months, potentially carrying Bitcoin toward new all-time highs and invigorating the entire sector in a manner consistent with historical post-consolidation phases. Alternatively, if external pressures mount, a period of extended consolidation or modest correction could unfold before the true breakout materializes later in the year, or into 2027, allowing for a healthier base from which to launch the next leg of appreciation. Investors and traders monitoring this situation would do well to focus on key levels, volume confirmation flow data reversals, and on-chain health indicators rather than succumbing to emotional reactions or unsubstantiated hype that often circulates during periods of indecision. position sizing appropriate to individual risk tolerance diversification, where suitable and a long-term perspective aligned with Bitcoin's fundamental value proposition as a scarce decentralized digital asset remain prudent approaches in navigating these waters, especially given the potential for both rapid upside resolution and extended periods of range-bound price action that can test even disciplined strategies. The coming days and weeks will likely provide more definitive signals as price action unfolds around these critical thresholds, with any decisive move likely accompanied by clear shifts in derivatives metrics and capital flow patterns that either confirm or refute the breakout thesis currently under consideration by market participants worldwide. As we wrap up this in-depth analysis, it is clear that Bitcoin at $64,000 represents far more than just a number. It embodies the tension between established market structures and the potential for disruptive growth that has defined the cryptocurrency revolution from its inception, creating both challenges for short-term traders and opportunities for those with a multi-year horizon who recognize the structural shifts underway in how value is stored, transferred, and perceived globally. Whether this marks the launching pad for the next massive breakout or a necessary pause in the journey, one thing remains certain: the evolution of digital assets continues to capture the imagination and capital of a global audience, promising both opportunities and challenges ahead that will reward those who approach the space with diligence, analytical rigor, and a commitment to understanding the underlying drivers rather than chasing fleeting narratives. The interplay between on-chain fundamentals, institutional flows, macroeconomic variables, and technical price action at this critical juncture will ultimately determine the path forward, making ongoing monitoring and balanced interpretation essential for anyone seeking to participate meaningfully in what remains one of the most dynamic asset classes of our time. Thank you for joining us here at Crypto Hub for this detailed examination of Bitcoin's current standing and future prospects. We strive to deliver balanced, insightful content that empowers our viewers to make informed decisions in the dynamic world of crypto without resorting to sensationalism or unsubstantiated predictions. If this update resonated with you, we encourage you to subscribe to the channel, engage with us in the comments below, sharing your thoughts on where Bitcoin might head next, and enable notifications so you never miss an analysis from our team. Remember, while we provide educational insights and market overviews, this is not financial advice, and all investments in cryptocurrencies involve substantial risk of loss, including the potential for total capital erosion, particularly in leveraged or concentrated positions. Stay vigilant, stay informed, and we look forward to bringing you more updates soon as the market continues to evolve around these pivotal levels. Until then, this is Crypto Hub signing off with the reminder that informed participation remains the cornerstone of navigating the opportunities and risks inherent in the cryptocurrency markets.